Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. Today we're going to be looking at some magic. Now, I'm no Andre Jick, so I can't do actual magic, but what I can show you is the magic of compound interest. As Albert Einstein once said, compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. So let's start off with what is compound interest. So compound interest can go one of two ways. It can either make you money or it can cost you money. So inflation is a very good example of where compounding negatively affects us. So what does compounding actually mean? Let's give you an example. So let's say you have $100. If you get an annual compounded return of, let's say, 10%, this means in year one, you get $10. So now you've got $110. Let's say in year two, you get the exact same 10%. On that $110, you're now getting $11. This means your portfolio is now $121. You again get 10% compounded the next year, and this means you get a return of $12.10. Meaning your overall portfolio at the end of year three is $133.10. If you compare that to a simple return of the same 10% a year, it means you get a return of $10 each year. This would mean at the end of year three, you have $130 compared to $133.10 with the compounding return. Now, this $3.10 might not sound like a lot of money, but if you're comparing it with hundreds of thousands of dollars invested in a market or over a much longer period of time, decades, for example, the difference between a compounded return and a simple return makes a massive difference. And I'll show you a few examples of compounding now. So let's start with the magic trick of how to devalue a currency. So as I've said before, compounding works in multiple ways. It can make your portfolio grow faster or can make your money worth less. If you haven't watched the previous video where I detailed what CPI is, after you finish up this one, make sure you go through my channel and have a good watch. And I'll give you a bit more of a context to what I'm talking about. So let's start off with currency devaluation or inflation. So let's go to the MoneySmart compound interest website. I'll make sure to link this below. Here we are on the MoneySmart compound interest calculator. Let's show you what happens when you devalue a currency. Now, what I'm going to do is I'm going to insert the initial value of $100. So let's say it costs you $100 to buy a pair of shoes today. The RBA tries to keep the inflation rate at around about 2 to 3%. So what we're going to do is we're going to put this into here. It does go up. We do see quite recently actually close to 9%, and at the moment it's about 4 to 5%. So it's a lot higher than the 2% target. But just for simplicity, I'm going to use 2% today. This will look a bit different because this is actually for growth, but you can consider it the exact same for inflation. So let's see what happens in 10 years' time. What we've got here is we've got $122. This would mean that in 10 years' time, the value, assuming the shoes are exactly the same and they have not changed, like they're still selling for equivalent of $100, they're now selling for $122. If we were to then change this out to 20 years, we can see it's now jumped up to $149. So there was a $22 difference in the first 10 years, but now there's a $27 difference in the second lot of 10 years. So that means you've lost another $5, which is about a 25% increase in the devaluation of currency. So it's now costing you $149 to buy the exact same shoes that would cost us $100 today. So let's go to a little bit of an extreme now. Let's say, how much do these $100 shoes cost us in 50 years' time? You can see here, it's now actually costing us $272. Considering we start off at $100, that's now over 2.5 times more expensive for the exact same thing. And it's a really good way to see that this is just using a 2% inflation. As I said before, it's currently in the 4 to 5% range. And quite recently, it's been as high as 9. It really goes to show just how much inflation rate can affect the value of goods over time and how important it is to make sure that you are increasing your wealth and income each year, whether that is through investments and getting income and capital returns through that, or through getting a better job or getting a pay rise in your current job to make sure that you are are keeping up at minimum with inflation. What costs $1 or $2 today is going to be significantly more expensive in the coming years. Okay, so I managed to show you guys how deflation works. Go from $100 pair of shoes to $200 plus pair of shoes for the exact same thing with just change in time. Now let's do something a bit more fun. Looks at what happens if your portfolio grows over time. Now, I can't actually use this compound interest calculator because it only goes up to 50 years. So I've actually got one that I've made myself, and I'll show it now. Okay, so here we are on the Excel sheet. What I've got nothing here, but it will pre-populate once we put in some numbers. So let's start and have some fun. Let's assume I've put in here the inflation rate. That's 2%. Personally, I like to make it a bit of a higher inflation rate. I like to go about 3%. As I said, the RBA target is 2 to 3%, and 3% is at the higher end, and that just gives us a bit more of a buffer. Up until pre-COVID, it has been a lot lower. It's been around 1, and this 3% just gives us a better buffer, and this will give us a return in today's dollars. For a return rate, 7% is fairly conservative. You could consider going up to 8 or 9, but I like to stay at 7% nominal, with 3% inflation giving us a 4% real return. So real return is what the value of your portfolio growth less inflation. So what we'll do now is see how long it takes to build a portfolio of $1 million. Now, let's say you start off with $100. Now, if you did nothing, you can see you're getting 4% return each year. It's growing over time. And if you did nothing, it would take you 235 years with 8% real return to get to $1 million in today's dollars, that is. Now, let's say we were to contribute $100 each year. Now, you would need to, because this is all in real dollars, you would actually need to increase your contribution with inflation, which is fairly easy. But you can see we had over 230 years before. Now, if we were to do that today, it brings us down to 153 years. I mean, that's still quite a long time, but you can see that this growth rate is actually increasing every single year. It is 4% in the first year because it's 4% of $100. It is then 4% of $204, which is $8.16. You can see by the 18th year, it is actually more than what we're actually putting in itself. It doesn't take long for it to be significant money. We're here 60 years to get to over $1,000, which is 10 times what you're putting in each year. 120 years to get to 10 grand. And then if you continue on further, 177 years to get over $100,000 a year in returns. So you can see the magic of compound interest is just how rapid it accelerates. To go from $12 to $100, which is a 10x, so it takes 15 years to increase your growth rate by about $90. To go up another $90 to come here is 9 years. It's almost half. And then to go up another $90 from 28 to 36, it's seen as 8 years. So it is going up faster and faster, and that is the magic of compound interest. I'll do one more very quick example, and this one is just more for fun. Now, how long do you think it would take to become a millionaire when you start with 10 cents and you contribute 10 cents a year? First thing to see is it takes 18 years for us to start having the growth being the same and greater than what we're putting in. It takes us almost 100 years to get to a portfolio balance of $100. It then gets us 150 years to get to $1,000, 212 years to get to 10,000, 270 to get to 100,000, and 329 years to get to $1 million. I don't think any of us are going to live to 330 years old, but it really goes to show you started off with 10 cents and you're only putting in 10 cents. While it did take a really long time to get to $1 million, it can happen, and all it is being consistent. This calculation is, look, it's not going to be representative of what the world actually is, because the market goes up, the market goes down, market goes flat. Each day is different. Each week is different. Each month, year, each decade is going to have a different return. This is just a very simple compounding using long-term averages. It is not representative of what the actual market does. Look, hopefully I've been able to give you guys a bit of a better understanding of how compound interest actually works and why it is so very important to get started early. If you've got any more questions, make sure to drop a comment down below. I will answer if I can. Thank you so much for watching, and I'll see you guys in the next one.